Bring in Vital Knowledge founder Adam Crisafulli and Hennion and Welsh Asset Management president Kevin Mahn. Great to have you both here on a day that had ups and downs to start the new year. Kevin, you're sitting here on set with us, so I'm going to kick this off with you because after 2 years of 20+% gains in the S&P, you could argue that a third year of really strong gains could be unlikely. You've only seen it one other time in history, which was the mid-90s. You're calling this the year of opportunities. Where do you see the opportunities?
Yeah, I'll start by saying it looks like the Grinch got in the way of the Santa Claus rally this time around. And I think this is a bit of foreshadowing of what likely stands ahead in 2025. Look, you just pointed out we've had, since 1950, 9 times the stock market has rallied by 20% or more in consecutive years, this being the 10th year. In 8 of those 9 instances, the stock market was higher the following year, but only by an average of 3.6%. So investors will need to be a lot more selective in 2025 to find those growth opportunities. I think there are many growth opportunities ahead, but expecting another 20% plus return in 2025 is highly unlikely.
Okay. Adam, I want to get your thoughts on this, especially given the fact that Jonathan Krinsky over at BTIG put out a note today and basically said that what the market's facing right now is a 3-body problem. Dollar and yields continue to exert upward pressure, and breadth remains poor. And until that changes, he sees downside volatility for stocks continuing here. I mean, the dollar index, just to give one example, is trading now as of today at a more than 2-year plus high. How do you see the market set up for this new year?
Yeah, no, definitely the dollar is going to be a headwind, as we start to get earnings reports in a couple of weeks for reported EPS and reported revenue. I think the market is still digesting some key macro events from a couple of weeks ago, specifically the recent Fed decision, where you did see a hawkish shift in the forward guidance with just 50 basis points of cuts guided for this year. And then importantly, what happened with the stopgap, that whole drama really caused expectations to fade a little bit on some of the initial Trump enthusiasm. If you kind of look at where what the market has done since the election, we've reversed a lot of that initial post-election rebound. And we're going to have to watch closely tomorrow to see how the speaker vote goes. Investors are very much on edge about the ability of Republicans to unify and pass some of the key pro-market pieces of the agenda, of the Trump 2.0 agenda, specifically on the tax front. So I think those 2 factors, the Fed and Washington, have been weighing on sentiment. But going forward, I think you're going to see kind of a broadening out of the rally. So for the S&P, the gains probably will not be as terrific as they have in the last couple of years. But beneath the surface, there still are some big pockets of the market that are trading well below the headline multiple. And the current macro setup, as far as just growth and inflation, are still in a relatively positive position, specifically on inflation. Some of the recent data has shown an important cooling in core services inflation.
Okay. So, Kevin, let's talk a little tactics. Yes. I hear a lot from investors who are tempted really to time the market here, tempted to sell, which sounds dangerous. But at the same time, there are a lot of people whose portfolios are probably way out of whack given the gains that we've had over the past couple of years, unless they were constantly rebalancing, which a lot of people don't do. What does rebalancing mean in 2025, especially for people close to retirement or beyond it?
Yes. Rebalancing and trying to time the market are 2 very different things. Trying to time the market is often an exercise in futility. Rebalancing your portfolio can help you achieve your longer-term returns and keep you in line with what your true risk tolerance is. So as I look at the next 2 years for the stock market, they're likely to look very different than the last 2 years, as we will continue in an environment where interest rates are becoming lower, where economic growth is going to become more stagnant, and the leadership of the prior 2 years is likely not to be the leadership going forward. So take some of your gains in those areas that have led the markets over the last 2 years and reposition them into different areas of the markets that will potentially lead going forward. One such area, how about biotechs? Look, one area that Democrats and Republicans agree on, perhaps the only area these days, is the need to lower drug prices. And as a result of that, large cap pharmaceuticals are going to have to become acquisitive to replace that lost revenue potential. I think of a company that we hold in our portfolios, Axsome Therapeutics, a $4.3 billion smaller cap biotech company that actually is developing therapies to treat central nervous system disorders. A great opportunity that large cap pharmaceutical companies will likely look to add to their own pipelines. So that's just one area of the place that you could potentially rebalance to in 2025.